Before the money moves, a small boat crosses the harbor dragging a sonar unit along the bottom. It is not looking for fish. It is measuring silt, foot by foot, because the buyer needs to know how much mud sits between the docks and deep water. A private equity firm is about to pay tens of millions of dollars for this marina, and that survey can move the price much more than the restaurant, the fuel dock, or the view. In February of 2025, Blackstone Infrastructure agreed to buy Safe Harbor Marinas, the largest marina and yacht service business in the United States, for $5.65 billion, and the main closing followed that April. The seller, Sun Communities, had bought the platform 5 years earlier for about $2.1 billion. Safe Harbor operated 138 marinas, while Sun reported nearly 49,000 wet slips and dry storage spaces. Sun told investors the price came to about 21 times the marina business's estimated 2024 funds from operations. That is a rich price for a company that stores boats, and it raises the question this documentary has to answer. What does an institutional buyer believe it is buying when it takes over a marina? And can a smaller buyer earn anything on the same asset? You start with the deed, because a marina is rarely one clean piece of property. There is the upland, parking, the ship store, the service yard, the rack building. There is the dock system, floating or fixed, with its pilings, power posts, and water lines. And there is the part outsiders never consider, the bottom. Depending on the state, the ground under the water may be owned outright, or belong to the public and be occupied under a submerged land lease. Separate what is owned from what is only allowed, because that line sets the whole risk profile. A marina owner is often renting the right to keep a dock where the dock already sits. That is also why capital is chasing this asset at all. Building a new marina in a place people want to boat is close to out of reach. New dock structures in navigable water require a permit from the Army Corps of Engineers. Add state environmental review, coastal zone rules, seagrass and wetland protections, local zoning, and local opponents, and a project can sit in review for years before one piling is driven. Dredging approvals can take years on complex sites. Existing marinas can disappear into redevelopment. New supply in prime harbors is tightly limited, and in some places it is shrinking. Now the money, which comes in layers of very different quality. The base layer is storage, wet slips priced by the foot of boat length each month, and dry stack racks where a forklift moves boats in and out. Rates vary sharply by market, boat size, location, and service level. Above that sits what Ownership Atlas calls the visible layer: the fuel dock, the service yard, the ship store, the brokerage desk. That layer creates big sales, but fuel often earns a thin gross margin after product cost, and service is a payroll business wearing a revenue costume. When Sun Communities bought Safe Harbor, it reported that just about 74% of that firm's gross profit came from storage and lease income. Boats moving in and out are the show. The contract is the business. The customer helps. Once a boat is in a slip, it tends to stay. Moving means a longer drive, a new yard, a new dock crew, and a place at the end of a waiting list. That is why a marina can raise rates annually and lose few boats. The trait that makes this asset resemble infrastructure to a fund, that also reframes capacity. Slip counts are how boaters describe a marina. Linear feet is how buyers price one. A 250-slip marina that averages 32 footboats has about 8,000 feet of dockage, and each added foot generates more monthly income against the same fixed cost. Owners widen slips and reconfigure docks for bigger boats accordingly. Capacity is measured in usable linear feet, and owners may change the slip mix for larger boats only when depth, permits, utilities, and construction costs allow it. Consider a sample purchase, an Ownership Atlas model rather than a real deal, in a southeastern coastal market. 250 wet slips that average 32 feet give 8,000 linear feet. At 90% occupancy and $22 per foot monthly. Wet dockage brings in about $1.9 million a year. Add 120 dry rack spaces, yielding about $600,000, and storage revenue is near $2.5 million. Fuel, service, and the store might turn $2.5 million of sales into maybe $500,000 of gross profit after fuel, parts, and tech wages. Against that, payroll, utilities, insurance, property taxes, repairs, and management run near $1.4 million. Net operating income lands near $1.6 million. Priced at a 6.5% cap rate, the going-in yield a buyer accepts initially, the Marina is worth about $25 million. Assume $10 million of equity and $15 million of debt at 7%. And interest alone is about $1,050,000 a year. Subtract an honest reserve of $350,000 for docks and dredging, and only about $200,000 remains before debt principal, repayment, and taxes. Roughly 2% of the original equity under this interest-only illustration. That is where the arithmetic begins at today's prices. $200,000 is also less than one dredge. Florida contractors quote about $20 to $100 a cubic yard for plain sand and silt, and $100 to $300 when the material is muck, access is restricted, or disposal is complicated. A city marina in Fernandina Beach was told its dredging would cost about $40 to $60 a yard, or $800,000 to $1.3 million. Pilings rot. Seawalls fail. Floating docks reach the end of their lives. Storm insurance on the coast can swing the whole year. That same city marina saw coverage rise from about $330,000 to $402,000 in 1 year. Insurance renewals can erase months of otherwise dependable marina earnings. Deferred underwater capital is the most common item a seller leaves behind, and the buyer inherits every foot of it. Why do large funds still pay up? Because they are not buying one marina. They are building a platform. Suntex Marinas, backed by Centerbridge Partners, completed a recap in 2021, absorbed the Westrec management business, and in 2024 formed a joint venture to buy more than $1.25 billion in marina deals, backed by a $600 million credit line. By early 2026, the portfolio had surpassed 100 properties. Scale can bring cheaper debt, group insurance, lower costs, and the ability to move a customer between harbors. An independent buyer receives none of that and faces the same storm, dredge, and renewal alone. The first year under new ownership tends to look the same. Rates that sat below market for a decade are repriced. Power gets metered. Things that were free start to carry a price. None of that is wrong, but a new owner should view it for what it is. Most early gains come from pricing the last owner chose not to take, and that lift can be taken only once. For more business breakdowns that show where owner cash actually lands, subscribe to Ownership Atlas. We take assets that look like lifestyle and follow the money until it reaches the owner or disappears into maintenance. Break. Even here is not a sales figure. It is the share of linear feet under annual contract that covers fixed costs, debt service, and a real reserve. Miss it and the place still looks busy. The lot full, fuel dock running, restaurant seated. Failure rarely appears as empty slips. It shows up as a low going-in yield paired with floating rate debt, a dredge priced too low, a policy that is not renewed, or the slow discovery that storage rates cannot climb as quickly as the expense of keeping water deep enough to use. Demand deserves scrutiny too. Final industry data recorded about 220,000 new powerboats sold in 2025. On a rolling basis through February of 2026, sales remained down almost 9%. Yet nearly 12 million registered and documented boats were already in use, helping explain why slips can stay full while showrooms slow. Even so, a marina underwritten on perpetual rate increases wagers that today's boat owners keep renewing, and renewals depend on how expensive the hobby becomes. Which is the trade-off worth arguing about below? If this marina were yours, would you fill every foot with annual contracts at a discount, buying predictable income a lender will finance, or hold slips back for transient boats that pay $2 to $3 a foot per day, accepting quiet winter docks for a much higher summer rate? Return to the survey boat and its sonar. The question was why the mud matters more than the restaurant, and the answer is now visible. A marina is not a hospitality business with a water view. It is permitted, one-of-a-kind infrastructure, and three variables determine whether it pays. First, how many linear feet sit under contract, and whether those contracts renew. Second, whether the site could ever be duplicated, because a permit nobody will issue twice supports the rate increases. Third, whether the work under the water has been funded honestly, since dredging, pilings, seawalls, and insurance decide whether net operating income turns into owner cash. When the three align, an owner holds genuinely scarce infrastructure that compounds quietly for decades. When they do not, the owner has bought a 2% yield attached to a duty that never ends, keeping a harbor deep. A platform absorbs that mistake across 100 properties. An individual absorbs it once. The docks are what everyone photographs. The asset is the water beneath them, the depth someone must keep paying to maintain, and the contracts naming who may tie up there.